So earlier this week, I was talking to my friend Evan, shout out, buddy, and it was on the heels of Monday's market rout, which, while unpleasant, wasn't as bad as what we experienced in early April when the S&P 500 pulled back almost 6%. But anyway, it was not a great day, and it's been a challenging week with at least the last couple of days being up. But but Evan asked this question, which I get from time to time, which was, hey, is there a point at which we go to cash? And, besides the fact that it sort of flies against the conventional wisdom of buying low and selling high, it illustrates a couple of the key mechanical differences between illiquid and liquid investments or assets. One, with the stock market, with the capital markets, you have ease of access. Arguably the most democratic environment for people to participate, where just about anybody can buy or sell a stock or equity fund. Two, you have daily pricing and liquidity. You have very transparent pricing and liquidity, which can contribute to the volatility and, to some extent, the illusion that we sometimes have that illiquid assets, like real estate as an example, are more stable. So the financial crisis of 2008 actually provides a really interesting case study or backdrop from which we can compare liquid and illiquid assets. As I said to Evan, at the depth of the financial crisis, most people weren't rushing out to sell their homes, but the fear we were all experiencing, or most of us were experiencing with our investment portfolios, was different in terms of the panic. And so it's interesting because if we look at the year-over-year returns in 2008, the stock market was down almost 40%, whereas according to the Case-Shiller National Home Price Index, the year-over-year decline was about half that. It was about 18%. Now, if we widen the time frame in terms of recovery, by the end of 2012, stocks were effectively in positive territory, whereas the housing market was still pretty depressed. And then if we go a step further and we take a more broadly diversified portfolio, so the green in the chart here is the stock market, the yellow is the housing index, and then the blue is this is just for illustration purposes, but this is just a 50-50 blended portfolio of stocks and bonds. And basically what you see with that diversified portfolio is less volatility, not down nearly as much. And then interestingly, by the end of 2012, you were effectively almost in the same place as if you would have had the same risk profile of being 100% stock. So, less risk and ultimately a similar outcome. And I think this is important when we think about liquid and illiquid assets and how they work. And, the fact that there's at times there can be this illusion of stability where in fact we're rewarded with the capital markets for being patient and being willing to ride it out. So let's go a step further in terms of thinking like an owner. Warren Buffett, arguably, probably not arguable, the most quoted investor of all time, to his 1980 in his shareholders report for Berkshire Hathaway in 1988, he said, "Our favorite holding period is forever." Now, you take it a little bit with a grain of salt. Really what he was saying is they want to buy great companies at reasonable prices, and they want to hold them for a very long time. Ironically, earlier this week, there was this headline in the Wall Street Journal about his perfect timing in terms of selling Apple stock. Now, again, let's look a little bit deeper than the headline. What actually happened? So up until the fourth quarter of last year, Apple represented a 36% position in Berkshire Hathaway. In the fourth quarter, they trimmed that position down to 28%, which is, I believe, around where it stands today. But the real point is this. He didn't get rid of Apple. He trimmed Apple. And then for relative perspective, In the S&P 500, Apple makes up about 7%. So Berkshire Hathaway's position, at least to the end of December of last year, was 4 times what it is in the S&P 500. So, the takeaway is think like an owner and understand that over the course of time, you're going to trim a portfolio, make adjustments, be tactical. That doesn't mean you get rid of everything that you have.